That's what you do. We need a New York one. Start streaming the news. Yeah. What's up with that guy? No love. I like that guy too. Yeah, it's all good. Hey, welcome to the Closing Beat, everybody. Happy, you know the trick. Happy Thursday. How you doing out there? Welcome to the Closing Beat. We are financial advisors here at Jazz Wealth. If you're looking to get your dough straight, come check us out there. This is naturally just marketing, but if I can teach you something at the same time, well, that is the goal. I got a couple things to focus on here today. Won't take much of your time, and I appreciate you guys watching. So let's get rolling in. Damn, looks good today too. We have earnings season going on here, and if you look through earnings season, we have over 175 names in the whole stock market that have reported so far. It's not the greatest. I've got good news, I got bad news, right? If I start with the bad news there, only 6 companies out of the whole 175 plus names that have reported now have beat on earnings, beat on sales, and made mention to raise their guidance. You call it like a three-peat or something like that. That's what everybody looks at, right? If those companies that do that, it means that fundamentally they're performing strong. They expect to continue performing strong. And those are usually the ones you want to read a little deeper into if you're interested in the financials and such, to kind of see, well, maybe there's something there. Usually the better performing stocks, and they're kind of have that momentum behind them. Not the greatest so far, right? 6 out of 175. We're on pace basically to do about, it'd be under 4% of all stocks reporting would have reported something like that. Typically that's around 6.5%. So a little bit of bad news there. It's early. It's very early still in earnings season, but that one's not so good. We got Doc in comments and Eloy. How's everybody doing there? Emilio, Matt, what's good? Mr. Bishop, greetings, greetings. Okay, now the good news, because that was kind of bad news. So if you like using economic news to prove my bet with Eric right that the Fed's actually driving a soft landing here and all's going to be good and it's not going to be chaotic and recessionary and all of that, then you really love today. Where did I put my notes? I got everything here. Initial jobless claims, essentially way below forecast, 186,000 versus the 205,000 estimated there. So way off there. Our first kind of look at the GDP numbers for the fourth quarter came in 2.9% versus 2.6%. Well, it's not amazing, but that's a beat, right? So we were expecting to see that kind of flatten. Instead, we got, you know, a little bit of a bump there. That's not recessionary. Durable goods, a little less common, followed Econ news there, but easily beat the forecast there. 5.6%, and so that was a beat. That was actually the best since we went through the summer of 2020, if you want to look back there. And our core PCE basically right in line there versus the expectations of 4.4. So good. Right? Economic news was really good there. I'll add one sort of contrarian indicator, last minute addition here, if you want to look. Consumer sentiment. This is just the consumer bullish sentiment. So the percentage of people that are bullish versus bearish, and that number is staying well below the average. Well, if you look back through the lifespan of this reading here, the number of people that are bullish, this number has been below average for now 55 weeks. That's a record. The previous record was set like in 1987 or something with 52 weeks. And so if we convincingly break this downtrend here in the stock market, that'll change that number, right? So right now people are pessimistic. They're saying, I'm not interested in the economy. I think the stock market's in big trouble. I don't want to be bullish right now. And they're being proven wrong so far to start. If you look across the S&P here, so far for the year, the S&P's up 5.75%. So do you trust it though? Like, I get this question I'm getting a lot throughout the day. Dustin, I see the market just kind of taking off there. Do you trust this rally? It seems a little bit odd, does it not? So if you are one of those that says, hey, I am actually pretty pessimistic right now, for the moment, it looks like you're wrong, getting left in the dust there. But hey, you know, that could all change in a moment's notice. If we go over to the S&P here and press this button, there we go. We are now moving above the downtrend there, and I'll say today started off with the big names moving the market, right? So it looked like one of those days where it was going to be just Apple, just Microsoft, and Alphabet, Amazon, Tesla with their earnings and everything. It looked like that's what was happening. But throughout the day, you started seeing, well, you had energy kind of strong all day, right? So that's, that was what it was. Obviously, Exxon breaking new highs, ConocoPhillips, Chevron, all amazing, great days for them. But throughout the day, you start having things like, oh, hey, Bank of America coming off of its lows and starting to move towards highs there. CVS moving off of its lows and towards highs. Starbucks getting its trend going there. Chipotle actually doing the same thing if you're going to stay in the same category. Honeywell, 3M, you look wherever you want, right? AT&T. Caterpillar, John Deere, Costco, Target, right? You could just keep naming names in the basic material space. You got Linde and Sherwin-Williams and things. Albemarle actually started by selling off and then pulled back up there. So it was one of those days where the big stocks set the tone initially, and you had people focused on tech, and you're like, all right, well, that's what's going to move the market today. But then throughout the day, you had index level buying. Right, where people said, I don't know, this is getting away from me. I'm going to buy the whole index. And that's what caused all those other stocks to start lifting throughout the day. It's good news if you're a bull. And it means that today's rally was not just tech-driven. Of course, you like to see that, right? Because any tech-driven rally should be suspect, not a representation of the broad strength in the market. Energy was strong all day. That's because you got oil just slightly higher on the day. And any energy name, I don't think... only EQT was the only one down. Yeah, every one of them up. And by the way, every one of them up more than 1%. You got Hess, Devon, Occidental Petroleum, EOG, ConocoPhillips, all very, very strong days over there. Remember, as January goes, so goes the market. And so this could change, but we're now sitting at the 26th of the month here. That was quick. Went by real quick. If January is strong, the first half of the year tends to be an average gain of basically 5%. And the rest of the year averages a gain of about 11%, which, as we covered yesterday, outpaces the average yearly gain of the stock market. If January is weak, then February tends to be weak. The first half of the year tends to be weak, and the whole year tends to be an average of a positive gain there. However, way underperforming the general stock market. The S&P is currently sitting at, like I said, 5.3. Yeah, there we go. Sitting at 5.3% for the year there. If you look at the NASDAQ, there you go. We did. So the NASDAQ's officially up 10% year to date. Just like that. Is that suspect? Well, we know it's all the tech stocks. It's those big guys that we were just talking about, Microsoft, Apple, and Tesla and stuff. So those are obviously driving the short-term gains here, at least as the beginning of the year. But is that going to continue? How often does the market gain, or does the NASDAQ gain 10% in January and then miraculously just continue throughout the year? What's the biggest gain for the year for the NASDAQ? And do we normally see that at the beginning of the year or the end of the year? You could actually use our research site to check that out. It was a bit of a tease because I just thought of that in my head. I did not do that research, but you can go into the research site, take a look at that, use the Qs or something like that. If you're not a research member, jazzwealth.com/research, huh? Not bad. All right, sector-wise, let's take a look at a few things here, and then I want to jump into going a little bit with the weaker stuff here. Communication services and consumer discretionary. I use the XLC and the XLY for those two sectors there. They are the first officially for the year to join the 10% club, right? Meaning they've gained over 10%. In fact, communication services has gained 14.4% for the year. That's one thing to say that in November, but to say that and January is not even done, it's impressive. Consumer discretionary up 12%, right? Now, clearly have a downtrend broken here. You're starting to see those sectors that like this, that are at the top of the list year to date, they're starting to break their downtrend, and not just a little bit like the S&P, very convincingly breaking their downtrend. Consumer discretionary, oh, come on. There you go. Short-term downtrend broken, big downtrend not broken yet, but there are a couple other areas you may look. You got financials, of course, breaking the downtrend and trying to break out as a whole. If financials just have one good day, that breaks out right there. That's seems like it's just blaring at you, right? You got real estate breaking the big downtrend there, creating the higher lows. Not quite as impressive as financials, but see that same look right there? Series of equal highs, building cause, building momentum to break up above those highs, which is kind of interesting there. What's really interesting, again, and I'll keep bringing this up, utilities. These are recessionary sectors. Utilities, consumer staples, healthcare, right? Recessionary type sectors that would do well leading up to or during a recession. They're going the opposite way. So utilities ranks as the worst for the year. It's the only one, it's one of the three. And in fact, only these three sectors are down on the year. Utilities down 2.25%. Consumer staples, the things we buy no matter what the economy is doing, is down 2% for the year. And healthcare is down at 1.5%. So there is no feeling of recession at the moment for these recessionary type things, sectors. And so I thought, since I'm like kind of not trusting this rally in the market, like what? All of a sudden everything's good. We're just going to go higher and pretend like this never happened. I thought it'd be fun to go through those recessionary sectors and say, well, of those that are pulling back, which ones are the most oversold, right? Are there any good deals to be had in there? In case you believe the same thing. So this will just take me a second. We'll start with consumer staples. So if you say, I don't know, bud, I'm a little bit worried about this. I think I'd like to have a little bit of safety here. The most oversold stock in the consumer staples sector right now is Pepsi. You can see it, right? Clear as day on the charts. There's your pullback. So if you believe the recession or weakness is ahead, well, that would be one of the weaker stocks to look at in that sector. The other one, there's only two, is McCormick. MKC is a ticker symbol. You know them, spices and things like that. Almost about hitting new lows here, right? So they had earnings come out and everything, and so that helped today. But you've got essentially a really oversold pullback in a recessionary sector. Just pointing those things out. Names you may say, well, I don't know that I'm interested in that. Estee Lauder, most overbought in the consumer staple space. So if you like momentum, you say, I'm going to go with that. I know I'm paying up for it, but I'm going with momentum. That's what I like to look at. Consumer staples is going to give us Lamb Weston as well. Same concept. You want something that's outperforming already. You don't want to guess on pullback type stocks. Well, that's where you're looking. Those are more common names. As you work your way over to utilities, it gets a little bit harder. You may not be familiar with a lot of these names unless they happen to be your utility company. NextEra. There you go. That's the most oversold stock in the utility space. If you're looking to add to that, you think that's a good deal, or you think the market's getting a little out of whack here, there you go. That's healthcare. I typed the wrong symbol there. So what else do we have? Only a couple of them. EverSource, the second most oversold in utilities. All right? So there's two names for you to look at there. If you look at healthcare real quick, since we're here, and I can just populate this list here. I just typed it a second ago. Molina, there you go. In the healthcare space, Molina, that's one of them there. Oversold Dexcom. There you go. I'll zoom back out for you. So oversold in a bullish kind of way, right? So this is pulling back in the short term, but otherwise had been more bullish than the rest of the sector. So that one kind of stands out a little bit. And then, of course, you'll have Johnson & Johnson. This is just from their earnings the other day, getting real wild. That's behind you now. So that is the third most oversold stock in the healthcare space. So I thought that would be cool to take the other side of things, and instead of going, all rosy Jim Cramer-like and saying everything's good, be diverse, but everything's good, I thought we'd go the other way and say, if you're a little suspect of this thing and what's happening with the market, but you want a way to play that, you would go back towards those underperformers at the moment. You could also use the research site to do a little bit of research and check out the stats on that as well. Our Wine and Wealth class here tonight at 8 o'clock Eastern Time is going to be with me. We're going to go over to the blackboard, and we're going to talk about return on capital. This year with clients, I'm focused more on General advice is great, but how do we go one layer deep, peel back that skin just a little bit and go an extra layer deep? We're going to talk about return on capital, and we're going to give you a bunch of different scenarios. We're going to say, let's say you have no clue what offerings are out there, and you just want to make a little return on the money that you put up for work, whether it's in a CD or high interest savings account. We'll talk about that. And we're going to work our way all the way up to using portfolio margins, selling covered calls, and get really, really deep with it, so that way, even if it blows your mind, you've never heard of something like what I just said, you at least know the ladder of risk to reward for maybe getting the highest return on your investment. So we'll talk about that. We'll include some real estate and we'll do some collectibles and things as well, just to have a little bit of fun. Stocks in the news here for the day. These are all earnings related. I'll just briefly go through them. There's too many to cover. So we got CSX here, beat on earnings, but very much just like Norfolk Southern, if you had a chance to read through either or both of their earnings reports there. Car loads, remember this is just a train. The train goes from here to there. How many car loads did it pull? The big boxes on the back. How many car loads could it pull? They said the same thing as Norfolk Southern there, that car loads were a little bit light. In fact, they were off by, I think it was 4% from expectation. It was 4%. Off by about 4% from expectations there. So if you look at CSX and you say, well, how is that telling you the economy's good? So on one hand, we got tech stocks going up. On the other hand, we got the very people that move the products that we're supposedly buying. How does that work? Anybody got a guess for that? If they're moving less car loads, how can the world be so good? You know the answer? There is, in fact, an answer. I'm not being sarcastic. We'll check in a second, see if you know the answer, and if I forget, somebody remind me. IBM, of course, one of the weaker ones here today. They're laying off like 2,000 people. The latest, quote, tech company to do that, so that was in the news. United Rentals, this is also an indication of the construction space there. This follows up with the data we shared yesterday that people are actually still going out and buying homes. They're willing to do it. They're willing to flip them. They're willing to do single-family homes. A lot of the world moved towards multifamily for a while. This is a good indication of that sort of construction exposure for remodeling single-family homes, commercial spaces, strip malls, and things like that. So something to look at there. And, of course, I did not type that. There we go. Anybody got any guesses for why CSX is not a fear at the moment? JetBlue, better than expected earnings. They were pretty positive going forward there. Obviously, it's kind of easy to steal the focus when Southwest is like, holy cow, what just happened to us? And then I'll point out MarineMax. So this was like a COVID stock. Remember, we all stayed home from COVID, so we're like, I'll go buy a boat, get a couple life jackets and some fishing rods. These were the guys that benefited from that. They were very downbeat going forward, which if you compare it to last year, of course, if you compare it to the year before, absolutely, right? So maybe a little bit of an unfair beating for them there. But in the short term, it's hard to find any love for MarineMax, but that was in the news. What do we got? Jazz After Dark. This week we talked about Roth IRA. Very simple. Dollars in, dollars out. How you invest those dollars. Then we talked about asset-based lending and how that all works. The good, the bad, and the ugly in some detail there. And then tonight we're actually going to cover our planner and how I was able to use that for a specific client to go outside of what you thought that planner would actually be for, to come up with a cool way that, yes, we can prove you can now absolutely invest for retirement or the long term and pay off debt at the same time without hurting yourself, without taking dollars away and saying, crap, I'm going to miss out on returns because I'm going to pay down debt. We can actually do both now. We're going to show you the geeky way of looking at that. All right, let's see what we got here. I'll take your questions. See if I can make this chat a little bit more visible for me. Fewer car loads due to fewer orders. Well, that's definite. Yes, you got it. Mm-hmm. So that makes sense there. Company's already sitting on the inventory. You could use that, but why would we say if JB Hunt, which is a trucking company, so let's just use transports in general. If transports are transporting less stuff, why is that not a concern for our economy? Why did we not see GDP numbers go down? Why are we seeing things look pretty good in the economy, specifically here in the U.S.? Gas prices not making it into the news. Okay, but that doesn't quite do that there. There it is. AJ, That's the winner right there. AJ got it. I didn't think anybody would get it. The reason is because we're not a product type society anymore. We spend our money on services. We spend our money going out to eat, going to concerts. We don't spend money as much as we used to on things, right? There's Amazon and whatnot, but a lot of that stuff falls into consumer staples, right? So that's the real reason. You can have a decline in car loads. You can see JB Hunt shipping a little less, or their volume, meaning how much crap they can plug into one of their trailers. That can go down a little bit, and it doesn't really matter. That's right. Cool. I love that, man. That's awesome. What do we got? I've been thinking about sending money to you all. What's your annual rate of return? You're thinking about sending some money to us, so we wouldn't be a good fit for that, right? So we're really focused on someone that says, take my life and make it work better than what we have financially. Of course, I can't fix your relationships and stuff. And so what we do with that is customize anything we have to. We obviously have our own funds that we'll pick and choose and use just for you because there's no cost and we can switch anytime. So each one of them ranks in terms of returns. It goes from very aggressive all the way down to super, super, super conservative. So we don't have just like one fund that I can say, oh, it gained 8% or, it gained 7% or whatever. And 9 times out of 10, what I find is I have to break those funds apart anyways. So I'm happy to try to fix your relationship, but I usually stand aside when I have like a husband-wife on the phone or something, and one wants to do one thing, one wants to do the other. I'm like, just let me know what you decide and I'll help you, but I'm not going to pick for you. That's dangerous. You know what I mean? That comes from years of experience right there. If you read through ASML or ServiceNow's earnings reports, what did you think? Did not. This is that time of earnings season where I got to be really picky and choosy here because I can't possibly catch all of them. And I like to listen to the conference calls too. There's a couple great services out there basically that you can search through transcripts a lot faster by keyword, and it'll break down like their 14-page thing into just a paragraph. But that's what it is. Do we offer dating services? I, in fact, cannot say that I've ever matched up a client with another client there. That would be something to do, though. Like throughout my life as an advisor here, I got a long way to go. If I could just add that to the list, like, hey, I know this client. They seem like they're just like you. And you could have like a little matchup. I'd probably run an ad. Giovanni, 370 puts, got 90,000 96,000 open interest. Yeah, that could very well be, especially on the SPY. So do you monitor hospitality, leisure, and travel stocks activities as a gauge for recovering economy? Yeah, of course. Yeah, you can. As a group, though, right? It can be where like Booking Holdings just, had a stellar quarter. Things like that can stand out, but as a whole, yeah, absolutely. I'll try to find that mock-up again. I'll go into our charts and try to print that out for you, where you can see since the 70s, you could see the progression of services versus the actual physical products. Yeah. Yeah. CVS. What was the question? Do you think CVS is a good buy? I mean, it's a long-term thing. I don't think and actually kind of short-term here. Check this out. So in a short-term, I've very much oversold and clearly people trying to pick the bottom here. I like what CVS is doing as a company, that transition, but that'll be a decade for them. So yeah, kind of in the short term and the long term, got a bit of a discount, don't you? So we are different from a mutual fund. Oh, absolutely. Yeah. We'll call our funds something just so that you see it has a name. So Brandon, if I find out that you are best suited for this, I'll put everything together and then we'll give it a name like Brandon's Fund, right? So that way you don't have to look at all the positions. But the difference between us and a mutual fund is you actually own all the positions. So if you ever needed tax loss harvesting or some strategic move, you don't have to sell the whole fund. I can just break it apart. And of course that there's no commissions and costs and stuff like that. Yeah, it's pretty cool. And that just comes from our background, coming from the fund side of things. It just seemed like a no-brainer to me. Why not? The majority of divorces are over money. Find people with... Yeah, that's true, right? If we're already talking money, like, hey, I got a client that just got divorced and they're good with the money. It sounds like you're good with the money. Could be happy right there. That's too funny, man. I appreciate that. The kind compliments there. Time to jump into Intel. Yeah, if you look at Intel and you're thinking now's the time and you're trying to make that decision over, you know, a Micron, NVIDIA, AMD, and you're going to go that route, you're playing the underdog game. So Intel has been the underdog. They've been seen as being behind. So you're betting on that changing. I don't have the most up-to-date how they're doing and things like that. But you could very easily say well, I'm one of those people. I like the contrarian approach. When someone's been beaten down, but it's a otherwise healthy company and they're just got a little bit behind, I like to play for that like roaring comeback sort of thing. Of course, I'm a Cowboys fan, so you know how that goes. Trading wine and weight stocks. Okay. You like your Constellation brands and whatnot? Yeah. There you go. Yeah, we talked about the financial sector a minute ago. It's right there at that sort of ceiling it's trying to bust through, and that's where the next round of momentum comes in. If it does, yep. Oh, yeah. All right. I've got to get ready for the old wine and wealth here tonight. And so we're going to do that. You guys enjoy the rest of your evening. If you're one of our clients, you're coming by, going to hang out with me later. We're going to talk about that, your actual return on capital, right? Instead of just putting money in something now, we're going to stop that, right? We don't have extra dollars just go throwing into stuff anymore. Money's getting tighter, so we want the highest return on capital for whatever you decide to invest in. I'm going to break that down little by little for you, and we'll see you later. Thanks for watching. Thanks for hanging out with us, and adios.